Welcome back to the channel, folks. This is Jason, host of Fighting Words Financial, and I want to talk to you about 6 signs of market doom. Now, in the last 12 months, we've all been experiencing a roller coaster ride, and I'm here to tell you that roller coaster ride may not be over. I think that we are going to experience some stomach churning moves between now and the end of June, and it's something I want everyone to be prepared for. You've probably been hearing for the last couple of months that this time is different. I'm here to tell you flat out that it's not different. It's completely normal, and this is all part of being a long-term investor. So in this video, I'm going to talk about 6 contrarian indicators that tell us that a new bull run is in the making. And when these indicators look their worst, that probably means that opportunity is knocking. But before I get started, if you like this kind of content, please subscribe, like the video, and turn on notifications. I'm really negligent about putting this in my videos, and I need to be constantly reminded. Also, check out the links in the descriptions. There are some goodies for you there. So what do I mean about stomach churning moves? Well, what I mean, of course, is market declines that make you feel like you're going to lose everything, combined with market surges that make you feel like you're going to miss out on everything. These are strong emotions that no one is immune to and may prevent you from sticking to your long-term investment strategy, and may also lead you to make decisions that are really detrimental to your overall portfolio performance over time. The volatility that we're all likely to experience between now and the end of June in our portfolios is not likely to be statistically significant over a long-term investment horizon, and that volatility is likely to be confined to a relatively reasonable range. That doesn't put the S&P below where it was in October of 22 or very far above where it is now. Now, there are 2 negative factors that are going to play pretty heavily into the market between now and then. The first being what the Fed does to combat inflation, and the second being whatever stupidity Congress gets up to over the debt ceiling debate at the end of June. There is a third factor that will counterbalance these two, but will likely not be enough to prevent some fits and starts with the market. Corporate earnings are not likely to drop off a cliff like many think they are, but we are going to see reduced earnings expectations going forward. What you'll likely see in earnings next quarter is that it's going to be a repeat of the last 2 quarters. Worst fears are not going to be realized, and corporate earnings in general will be described as not as bad as I thought they would be. So there are some reasons to be concerned about your portfolio, but in all seriousness, signs of impending economic doom are just not there. And when I say signs, let's talk about the 6 very specific short-term indicators I use to make that statement. Number 1, money flows out of stock funds. Number 2, the very contrarian investor sentiment survey. Number 3, corporate versus treasury bond spreads. Number 4, put versus call spreads. Number 5, the VIX level. And number 6, my least favorite, which is 200-day moving averages. So in all seriousness, all of these are contrarian indicators. The worse they look in combination, the more likely it is that the market is close to a bottom and a new bull market is forming. These, of course, aren't ironclad, as nothing in the economy is ever really certain, but they are really good indicators. So let's take a look at current levels, and remember, you want these to look bad. Number 1 is money flows out of stock market funds, and this is what it looks like today. That's pretty bad, right? It may not have even peaked, and it might get a little worse, but that is actually what we want. So let's talk about what normally happens in a bear market. Money flows out of stock funds. Typically, that lasts between 8 and 9 months during a bear market, and this negative flow of money started in June. We are already hitting the historical average right now, and these flows could reverse at any time. I think this will happen a little bit later, though, when it becomes more clear what the Fed is going to do in the immediate term. Additionally, this reversal of flow typically happens way before the economy actually improves, and stock prices rise well in advance of improving GDP numbers. So this contrarian sign is actually really good. Number 2, the AII Weekly Investor Sentiment Survey. This is a measure of where investors think the market will be 6 months from now. This is the mother of all contrarian indicators, in my opinion. The worse investor sentiment is, the more likely that it is that returns are going to be spectacular in the next 6 months. Bulls see a higher market where bears see stocks being lower. When the bears outnumber the bulls by more than 30%, that is a good sign. This indicator is giving us lukewarm signs right now that most investors are neutral, edging on greedy. I honestly hoped for more despair. Wow, so outside of this context, that statement is probably only uttered by dictators and psychopaths. But seriously, I would be a lot more positive about the markets if this survey was a lot more negative. Number 3, corporate versus treasury bonds. Okay, before your eyes glaze over in boredom, I have to point out that this is probably the most important indicator that there is out there of where professionals think the economy is going. The bond market is supposed to be smart money, right? The vast majority of it traded by pension fund managers and other large institutions. This credit spread often tells a very different story about the future of the economy and stocks. This is another sign where maximum pessimism usually signals a bull run in stocks. This happens when rates on risky bonds surge compared to those on theoretically safe treasuries. When the yield premium on high-grade corporate bonds rises above 2.5% versus the treasury yield and 8% on junk bonds, historically, that's when too much bankruptcy risk has been priced in. Stocks then tend to do very well as corporate pessimism subsides. Data from the Federal Reserve tells us right now that the junk bond to 10-year treasury spread right now is about 1.83%, which is nowhere near the level of pessimism that I crave. And the current investment grade bond to 10-year treasury spread is roughly 0.83%, which is kind of pathetic when I'm looking at something that gauges fear, which tells me that bond traders do not believe that there are significant indicators of bankruptcy for companies that issue bonds, even companies with questionable credit quality. Not the sign that I am looking for if I think the next bull run is here, but not one that suggests a massive decline either. The options market can be a really good clue when it comes to market sentiment. This is a lesser known indicator, but the put to call ratio can be another good signal to watch when you are in uncertain times. When put option trading exceeds call option trading volume, that tells us that bearish expectations are on the rise. Once again, it can be a contrarian indicator when the daily ratio of put volume to call volume rises above 1.5. Anything over 1.0 is a bearish sign, which is what I want. The current ratio is 0.82, which is not bearish enough, but anything over 0.7 is moving in the right direction for me. Consider this sign very neutral, but moving bearish since February 1st. Number 5 is the VIX level. The VIX is a measure of investor fear represented by expected volatility in markets. A sharp spike is a good sign and a really simple indicator that shortly sharks are going to smell blood in the water and typically money flows back into the market. The VIX is not giving me the bear signal that I want right now, but let's realize that it's a very short-term indicator and only projects out for the next 30 days or so. The average spike when things start to look really bad is around 45, and currently we are sitting around 21. This would indicate to me that investors in the short term are still mildly bullish, and I want to be greedy when everyone else is fearful, so this just isn't what I want to see. The last sign that I look for is the 200-day moving average. This is probably my least favorite indicator, and I do not use it to trade individual stocks because my time horizon is just too long for it to matter. But it can be a useful tool to gauge current sentiment in combination with all of those other metrics that I just talked about. Right now, roughly 34% of stocks on the S&P 500 are trading above their 200-day moving average. Typically, you want this percentage to be in the 10 to 15% range to indicate a market bottom and a new bull run. So if we put all these signs together and I look at them through my crystal ball, and the picture is just about as clear as mud as it usually is with my crystal ball, there doesn't seem to be an indication of impending market doom. There also doesn't seem to be an indication of a new bull market anytime soon. To be fair, though, there is less despair and pain than I was hoping for this late in a bear market. Here is what I think happens in the next 6 months. The market trades sideways to slightly down for the next few months through June. I think only a few stocks are really going to perform well in this time period, and most everyone else is just going to be carried along by the tide. I think that VIX, bearish market sentiment, and call spreads peak sometime in late June. After that point, I think we have a much larger window for a potential new bull market. So this is my message to you, that this new round of market doldrums is not going to last forever. If you have a long-term investment strategy that fits your risk tolerance and goals, don't deviate from that. Outside of some completely unpredictable black swan events, there really isn't a reason to change your long-term goals based on what's happening in the short term.
Steady hand on the tiller, my friends. I hope you enjoyed this video. Please like and subscribe, and I'll see you next time.